Argentina borrowed too much. They collapsed. They did it again and again, 9 times in total. Argentina holds the modern record for sovereign default. 9 separate moments when its government told the world we cannot pay. But Argentina is not alone. Greece borrowed too much. Its economy shrank by 25%. An entire generation left the country searching for work. The Ottoman Empire borrowed too much. By 1875, it could not meet its obligations. Foreign creditors took control of its tax revenues. Within decades, the empire dissolved. Mexico borrowed too much. Brazil borrowed too much. Venezuela borrowed too much. In the 1980s, much of Latin America collapsed under the weight of debt. They called it the lost decade. Do you see the pattern? Because the bankers do. They have watched this cycle repeat for 2 centuries. They know exactly how it begins. They know exactly how it ends. And every time a country hits replay, someone profits. There's a sequence to sovereign collapse. It is almost mechanical, predictable, documented. First comes a crisis, a war, a recession, a commodity crash, a pandemic. The government faces a shortfall. Revenues drop, spending rises, fear spreads. Then comes the loan. Foreign banks arrive with capital. International institutions offer assistance. Interest rates seem manageable. Terms appear reasonable. This is temporary, politicians promise. We will grow our way out of it. The public breathes easier. Spending continues. Sometimes it even increases. For a while it works. Growth returns. Confidence rises. Asset prices climb. But the debt does not shrink. It compounds. Interest payments grow quietly in the background. A larger share of government revenue goes toward servicing past borrowing. Less goes toward investment. Less goes toward resilience. Then another shock hits, and suddenly the numbers no longer add up. Investors panic. Bond yields spike. Capital flees. The country that borrowed to escape one crisis finds itself trapped in another. This is when institutions like the International Monetary Fund arrive. They do not come with celebration. They come with conditions. Cut spending, raise taxes, reduce subsidies, privatize state assets. Austerity begins. In the streets, protests erupt. Savings evaporate. Unemployment surges. The political system fractures. Extremes gain power. Trust collapses. Eventually, the inevitable announcement arrives. We cannot pay. Default. Creditors take losses. Banks restructure loans. Markets reset. Years pass. Memories fade. And the cycle begins again. Why? Because incentives are misaligned. Politicians think in election cycles. Debt compounds over decades. Voters enjoy benefits today. Future voters inherit the bill. Creditors collect interest while times are good. When times are bad, they negotiate from strength. Heads, they win. Tails, the public pays. This is not conspiracy, it is structure. And structure is powerful. The debt trap is not about one irresponsible country. It is not about one corrupt government. It is a recurring pattern in global finance. From Buenos Aires to Athens, from Istanbul to Mexico City. The names change, the language changes, the century changes. The pattern does not. In the next part, we begin with the most experienced repeat offender in modern history, Argentina, the country that once ranked among the richest in the world, and then fell into the trap. At the beginning of the 20th century, Argentina was one of the richest countries on earth. In 1913, it ranked among the top 10 nations in GDP per capita. Richer than France, richer than Germany. Its fertile pampas produced endless wheat and beef. European immigrants flooded into Buenos Aires. Grand boulevards were built. Opera houses rivaled Paris. It looked like a country destined for permanent prosperity. But beneath the surface, there was a weakness. Argentina's wealth depended almost entirely on exporting agricultural commodities. It sold food to Europe. It bought manufactured goods in return. As long as global trade expanded, the system worked. When it slowed, the cracks appeared. The first major default came in 1827, barely a decade after independence. The young government had borrowed from British banks to fund a war with Brazil. It could not repay the loans. Default. In 1890, it happened again. The government borrowed heavily to build railroads and infrastructure. A speculative bubble formed. When it burst, even the London banking house Baring Brothers nearly collapsed from exposure to Argentine bonds. Rescue packages followed. Confidence returned, and the cycle resumed. The 20th century turned Argentina into a master of repetition. In 1930, a military coup overthrew the government. The new regime printed money to manage debt. Inflation soared. Savings evaporated. In the 1940s and 1950s, President Juan Perón expanded social programs. Industries were nationalized. Wages increased. For a short time, growth surged. But spending outpaced productivity. Debt mounted. By 1956, another default. Borrow. Grow briefly. Ignore structural weakness. Default. Restructure. Repeat. The 1980s were catastrophic. Across Latin America, debt spiraled out of control. Argentina was among the worst. Inflation reached 3,000% per year. prices changed daily. Workers were paid and rushed to stores before money lost value. A military junta borrowed billions. Part of it financed a disastrous war over the Falkland Islands. The war was lost. The debt remained. In 1982, Argentina defaulted again, this time owing roughly $43 billion. The 1990s brought apparent reform. President Carlos Menem pegged the peso to the US dollar. 1 peso equaled $1. Inflation collapsed. Foreign investment poured in. Privatization accelerated. For a moment, it felt like redemption. Buenos Aires sparkled again, but the peg was fragile. To maintain it, Argentina needed constant inflows of dollars. When growth slowed, borrowing increased. Debt piled higher. By 2001, the illusion shattered. Investors fled. Bank accounts were frozen. Citizens banged pots and pans in the streets. 5 presidents cycled through office in 2 weeks. In December 2001, Argentina defaulted on $93 billion. At the time, it was the largest sovereign default in history. The economy collapsed. Poverty surged. Middle-class savings were wiped out. Yet, even that was not the end. In 2020, during the COVID pandemic, Argentina defaulted again. 9th time. Why does it keep happening? The answer is structural and political. Argentina still relies heavily on commodity exports. When soybean prices are high, dollars flow in. When prices fall, revenue collapses. But the deeper issue is incentives. Governments promise subsidies. They promise pensions. They promise stability. When revenues cannot support those promises, they borrow. Debt becomes the bridge between political ambition and economic reality. Future administrations inherit the bill. When they cannot pay, they restructure, and the cycle resets. Argentina's tragedy is not a lack of resources. It has fertile land, an educated population, vast natural wealth. Its tragedy is the repeated choice to postpone hard reforms through borrowing. Each default damages credibility. Each restructuring raises borrowing costs. Each crisis erodes trust. The country that once rivaled Europe became synonymous with instability. Argentina is not poor because it lacks potential. It is unstable because it never escaped the debt trap. And its story is only the beginning. Long before modern financial crises, the same pattern unfolded inside the Ottoman Empire. For centuries, it was one of the most powerful states on earth. From Vienna to Yemen, from Algeria to Iraq, the empire expanded through conquest. New land meant new taxes. New taxes meant a full treasury. Debt was unnecessary. But by the 19th century, expansion had stopped. Territories began breaking away. Greece won independence. Egypt became semi-autonomous. The Balkans were in constant revolt. Wars were frequent. Armies were expensive, and the old system no longer worked. The empire needed money. Fast. European bankers were ready. Beginning in the 1850s, Ottoman rulers borrowed heavily from London and Paris. The loans were marketed as modernization funds, railways, telegraph lines, ports, reform. The empire would modernize and grow stronger. At least that was the promise. In reality, much of the borrowed money vanished into palace construction and elite luxury. Sultan Abdulaziz spent lavishly. New palaces rose along the Bosporus. Court expenses ballooned. Provincial leaders were bribed to maintain loyalty. Corruption flourished. Between 1854 and 1874, the empire borrowed roughly £200 million, an astronomical sum at the time. Interest payments piled up. By 1875, more than half of government revenue went toward paying interest alone, not principal, just interest. The math was impossible. In October 1875, the empire announced it could only pay half of what it owed, a partial default. European markets panicked. Creditors demanded control. In 1881, the Ottoman Public Debt Administration was established. It was effectively run by European powers, French officials, British officials, German representatives. They took direct control of key tax revenues: tobacco taxes, salt taxes, alcohol duties, silk revenues. Money that once funded the empire now flowed directly to foreign creditors. The Sultan still ruled, but financially, sovereignty was gone. Imagine a government unable to collect its own taxes. Imagine foreign administrators sitting in your capital collecting revenue before your treasury sees a coin. That was the Ottoman reality. Debt had become political control. The humiliation was profound. Nationalist movements grew stronger. Subjects in the Balkans questioned why they should remain loyal to a bankrupt empire serving foreign banks. Rebellions intensified. Military spending increased again. More borrowing followed. The trap tightened. By the early 20th century, the empire was fragile. It survived partly because European powers feared instability more than weakness. Then came World War I. The Ottomans sided with Germany. German loans flowed in, defeat followed. In 1923, the empire formally ended. Its successor state, modern Turkey, inherited roughly 60% of the old empire's debt. Decades were spent paying loans taken by sultans long gone. The lesson is stark. Debt does not only damage economies, it can strip sovereignty. When interest consumes revenue, policy becomes constrained. When creditors control taxation, independence becomes symbolic. The Ottoman collapse shows the long arc of financial decline. Borrow to modernize, borrow to survive, borrow to suppress revolt, eventually lose control. The empire was not destroyed in a single battle. It eroded through decades of financial dependency, and its story echoes forward into modern times. Because when nations borrow beyond their capacity, the consequences are never purely economic. They are political, they are social, and sometimes they are existential. In the next part, the pattern moves to the 20th century, to an entire continent, and to a crisis that reshaped global finance forever. The pattern did not end with empires. It returned in the late 20th century, this time across an entire continent. In the 1970s, oil prices exploded. OPEC imposed an embargo. Energy prices quadrupled. Oil exporting nations accumulated massive cash reserves. They deposited billions into Western banks. Those banks needed borrowers. They looked toward Latin America. Mexico borrowed heavily. Brazil borrowed heavily. Argentina borrowed heavily. Venezuela borrowed heavily. Loans seemed cheap. Interest rates were low. Growth projections were optimistic. Governments promised development. Infrastructure expanded. Industrial projects multiplied. But corruption spread. Capital fled. Debt accumulated quietly. Then came 1979. The U.S. Federal Reserve raised interest rates dramatically. Global borrowing costs surged. Many Latin American loans carried variable rates. Interest payments doubled, then tripled. At the same time, a global recession hit. Demand for exports collapsed. Commodity prices fell. The dollars needed to service debt vanished. In August 1982, Mexico announced it could not pay. Shockwaves hit global markets. Major banks were exposed. Fear spread rapidly. Brazil faced insolvency. Argentina followed. The region entered what became known as the Lost Decade. The International Monetary Fund stepped in. So did the World Bank. Emergency loans were offered. But they came with strict conditions. Cut public spending. Reduce subsidies. Privatize state industries. Raise taxes. Open markets. Austerity reshaped entire societies. Real wages in Mexico fell sharply. Inflation in Brazil reached thousands of percent annually. Argentina's economy contracted severely. Unemployment surged. Poverty increased dramatically. Middle classes shrank. Protests filled the streets. Democracies were tested. Political instability followed. The crisis lasted nearly a decade. Growth stagnated. Investment dried up. Millions saw their living standards collapse. Eventually, restructuring programs like the Brady Plan eased the burden. Some debt was forgiven. Payments were extended. But the lost years never returned. The bankers survived. The public paid the price. Fast forward to 2010. The crisis reappeared in Europe. Greece had joined the euro. Cheap credit flooded in. Public spending expanded. Deficits were hidden. And when the 2008 global financial crisis hit, investors looked closer. The debt was enormous, over 130% of GDP. Markets panicked. Bond yields spiked. Greece required massive bailouts. The European Union intervened. The IMF intervened. Austerity returned. Public wages were cut. Pensions were reduced. Taxes increased. Unemployment reached 27%. Youth unemployment surpassed 50%. GDP shrank by roughly 25% in 5 years. An entire generation emigrated. The pattern repeated again: crisis, borrowing, shock, austerity, social pain. Today, the warnings are growing louder. Since 2020, multiple countries have defaulted or restructured debt. Sri Lanka defaulted, and Lebanon defaulted. Zambia restructured. Ghana sought relief. Global debt levels are historically high. Governments borrowed heavily during the pandemic. Interest rates are rising again. Economic growth is slowing. The ingredients are familiar. Politicians still think in short cycles. Debt still compounds over decades. Voters still prefer immediate relief. Creditors still chase yield. The trap remains intact. History does not repeat perfectly. But it rhymes relentlessly. From the Ottoman palaces, to Buenos Aires, to Athens, to modern emerging markets. The lesson is consistent. Debt can fund growth, but unchecked debt can erase it. And when the bill finally comes due, it is rarely the decision makers who suffer most. It is ordinary citizens. The question is no longer whether the pattern exists. The question is who steps into it next. The debt trap is not a relic of history. It is very much alive today. Argentina continues to cycle through defaults. Turkey struggles with a collapsing currency. Pakistan teeters on the edge of crisis. Even wealthy nations are vulnerable. United States, Japan, and Italy carry unprecedented debt levels. Globally, debt totals over $37 trillion. That is 336% of global GDP. Some of it may never be repaid. The question is which nations will default next, and how severe the consequences will be. The pattern is clear. Politicians borrow to fund popular programs. Creditors earn interest. Future generations pay the cost. Heads, the bankers win. Tails, the public loses. The human toll is staggering. Generations suffer lower wages. Savings are wiped out. Opportunities vanish. History shows no mercy. From Argentina to Greece, from the Ottoman Empire to Latin America, the cycle repeats. Debt without reform leads to crisis. Borrowing without accountability leads to instability. Yet the incentives remain misaligned. Politicians think short-term. Bankers profit. The public pays. Until incentives change, the cycle will continue. The debt trap is the defining economic challenge of our time, and it is only getting bigger. The real question is not whether another crisis will happen. It is when, and who will be forced to pay the price. History is watching, and it has already given us the answer.